Hi, welcome to this video, Dave, which is all about Forex trading basics for beginners. And what we're going to be looking at today is leverage. Just going to explain quickly what it is for complete beginners. And then what we're going to look at is getting the optimum leverage for you, which is basically going to maximize your profits to make your money longer term from the markets, but also give you good risk control so you don't blow up your account. Now, in terms of most beginners that come in the markets, the reason they lose all their money pretty quickly is they're over leveraged. I've worked at numerous brokers and seen this. Also, a lot of those traders had good strategies that could have worked. They just exposed themselves to undue risk. Okay. Now, what I want to do, just go and just summarize on a quick storyboard some tips in relation to balancing the risk reward when you are working out your leverage. So let's just go and take a look at the tips. Right, let's look at some tips in terms of leverage that you should use and balancing the risk to reward so you can maximize profits, keep risk to manageable levels. Now, first point, all brokers are going to give you too much leverage, okay? You see 200 to 1, even 500 to 1. 500 to 1 every 1,000 you've got in your account can control 500,000 in the market. If you use anywhere near that, obviously, you're just going to see your account go down. You're going to get wiped out. Brokers obviously give too much leverage because it's the old adage, give them enough rope and they'll hang themselves. They know beginners are going to over leverage. And if they know that that's going to happen, they're going to make a lot of money out of the clients. I always think that 10 to 1 in terms of leverage or 20 to 1 in terms of leverage is the maximum that you're ever going to be in terms of exposure. Okay, but you don't work out the leverage you're going to use. Okay, you don't need to. You do it by working out risk. Okay, then the leverage will just take care of itself. Sometimes it might be 10%. Sometimes it might be a bit more, a bit less. It depends. And this will become clear when I explain the way to do it. I put 10% maximum risk exposure on your account. So all your positions go wrong. That's the maximum you can lose. If you go above that maximum risk exposure, the risk to ruin odds increase dramatically, which the Kelly formula will tell you, which is a mathematical formula. In terms of you're a beginner, I'd probably risk a little bit less while I was learning the markets because you're bound to make mistakes. So I probably have 5% as a risk exposure, but 10% should be your max. Okay, now you can still use too much leverage even if you've put that 10% risk exposure in place. Let me explain how this occurs. A lot of traders will they'll calculate their position size first, okay, how big it is, and then do a close stop, okay. So you see online, a lot of people saying use really high leverage, 20 pip stops, 50 pip stops, and you'll be able to make money, okay, using just very tight stops on big positions. That's what amateurs do, okay, because they do not understand volatility and risk. And what I mean by this is that if you think about an average currency pair, it can move 100 pips a day. Most of the time that is just noise and random. So if you've got your stop within the noise, you're going to lose. Okay, what you need to do is not calculate the position size first. You calculate the risk on a realistic stop, okay, and that will give you your trade size. So what do I mean by that? Well, let's say we were risking the whole 10% on one trade, just for illustrative purposes. If you had a stop loss of 100 pips, okay, that position size would be double of one you had a 200 pip stop loss on, okay? Now, in terms of stops, I mean, it's only a rule of thumb, but if you're a swing trader, you're probably going to be using 100 to 150 pips, a trend follower, probably 200 or more. Just always work out your risk to stop first. That calculates your trade size. Don't do it the other way round. That way, is the correct way to do it. Okay, yeah, there are so many traders actually who use close stops, and it just isn't a good idea. Okay, over time you just lose your money. Now, another mistake that people make is they think, well, I can risk quite a bit of money because I'm trading uncorrelated pairs. I've seen people do this, risking 20 to 30% of their account. And what they say is that, because the pairs are uncorrelated, if they lose on some, they'll win on others. Well, that's true to a degree, but your winners will just cancel out your losers. And sometimes, and it happens very often, pairs that have been uncorrelated for a while suddenly correlate, and then that idea totally breaks down. You get an account wipeout. Now, in terms of diversification, uncorrelation, it just doesn't work. Diversification basically does not reduce risk. If one trade can go wrong, if you've got one on, or if you've got 10 trades on, 10 trades can go wrong at once. It does happen, okay? So diversification doesn't reduce risk. It just simply dilutes your profit potential. Now, Warren Buffett always made the great statement, which is people who diversify for the sake of it just simply do not know what they're doing. My own view is to have a maximum of 6 pairs. That should be your maximum. I normally only use a maximum of 4 because you just focus on the high probability trades as you see them. You don't just put in trades for the sake of putting in trades. Now, in terms of that little checklist, I think if you just follow it, you'll be able to have a risk level that is tolerable, and you'll be able to make really, really good money longer term. Obviously, you've got to have a strategy with an edge you're confident in. But those general rules have worked well for me over the years. I hope that they were helpful and they work for you. Thanks very much for watching me. Take care. Have a good day.